I gotta change it back. I just gotta change it back again.
Good morning.
Good morning.
How you all doing?
All right, how are you?
Doing good.
So I'm gonna make you the host again.
The host or the co-host?
Yeah.
Now, the D host is a capital T in that.
The host.
Randy, you something else.
I could put a Z in there, Z host. You are Z host.
No, that's Gwen. I'm just her assistant.
Now, she said you were her technical person.
That's right. I'm a technical staff.
Make it happen. Okay, you got a nice big picture of Barack Obama in the background. Yeah,
Yeah, Gwen made that puzzle.
that's a puzzle.
Oh, puzzle. Okay.
Yeah, and so is the one with Muhammad Ali and Nelson Mandela. All those are puzzles.
Okay.
Yeah, you got to get the puzzles right. You don't want anything out of place. Make it look different.
She can't stop making puzzles. I don't have the patience. I tried. I tried with the big pieces.
It looks like actually we're recording. Do you see?
Okay.
Yeah.
So
Yeah.
You see that you're the host.
So let me check the share now. Okay. Good morning.
Good
Pat.
morning. Good morning.
Good morning. Good morning.
And I think we all know Gwen, Gwen Carney. She's a certified public accountant, and this is at least her third year speaking to us. And the topic she speaks to us every year is on taxes. And I know many of you were at those two prior meetings, and she gave, Zelda and I know, she gave us some advice that we use to not give Uncle Sam as much money as we probably would have given him, but for listening to her advice. And we know that Gwen tells it like it is, and she gives it to you straight. And that's something that I know we are very appreciative of. And without further ado, we're going to turn this matter over to Ms. Gwen Carney.
Well, good morning, everyone.
Good morning.
So first I want to welcome you and to thank you for taking time out of your busy day to spend with me to learn just a little bit about the changes that have occurred with the tax code so that you can be better prepared to prepare your 2020 taxes. But before I get into it, I always have disclaimers because no one person knows the entire tax code. So I will do my best to answer any questions that I could possibly answer. I ask that if a question comes to your mind while I am going over a particular subject, feel free to put the question in the chat box. And then we will get to those questions. And there'll be a couple times during the presentation where I will stop to ask questions to see if anyone has any questions so that I don't overwhelm you with too much at one time. My tidbit let's say this, my recommendation for you at this moment is if you have paper and pencil, you may use it because I really think you will hear something that you want to jot down. So this will be an opportunity to jot it down. But before I dig into the changes that have occurred, I'm gonna bring up a slide, and I felt that it would be most appropriate for us to just refresh our memory on things that occurred in 2019 that are still evident right now. They still exist right now. So can everyone see the screen that says tax season tips for 2021? Okay, all right, long as y'all can see it. You got it.
Yes.
Okay, so let's refresh your memory. The first thing I want to go over is that there were numerous persons who could no longer itemize their deductions because they increased the standard deduction in 2019. And when I show later on, there's another chart that I'm gonna show you, that level has gone up even more for 2020. And it's gonna go up even more for 2021. So if you couldn't itemize in 2019, unless something extraordinarily happened, like you decided that, you know what, I'm gonna go in that closet, clean out my closet and send it, take it to Goodwill, and therefore I have a larger deduction for itemizing, then most likely you're still gonna have to use the standard deduction for 2020. So that is just something that did happen in 2019 that will also be present in 2020. The next thing that happened is that the IRS did away with personal exemptions. Personal exemptions were eliminated. We used to be able to get $4,050 per person on the tax return. So if you had a family of 4, that was over $16,000 that you used to be able to reduce your income by. The personal exemptions no longer exist. So we're still back to, we have to use standard deduction or itemized deductions in order to reduce our taxable income. The next thing that happened, those who are able to to use itemized deductions, you were limited in the area that speaks about taxes. Excuse me, there's an area on Schedule A where you were allowed to deduct all money that was withheld from your paycheck in the way of state taxes, or was withheld from your retirement in the way of state taxes withheld. You also could deduct real estate taxes that you pay on your current residence. And even if you had a second residence that you were paying real estate taxes on, you could deduct it. You also could deduct taxes that you pay personally on your vehicles. So let's just pretend that by the time you add all those figures together, let's just pretend that your taxes turn out to be $12,000. Well, the itemized deduction Schedule A now limits you to $10,000. So once it reaches $10,000, you're not going to get another deduction past the $10,000. I don't care what you put on there. $20,000, you're not going to get, but the $10,000 deduction. So that law is still true for the 2020 taxes. The next thing that happened in 2019, there was an area where we had miscellaneous deductions that covered things like your tax preparer fees. You could have some job related expenses where, say, you travel to and from for your, for your job, or you have classes you took, for your job that were not reimbursed. Just what we would call employee business expenses. So employee business expenses used to come under the umbrella of miscellaneous, subjected to 2% of your adjusted gross income. And so that is no longer available either. The child tax credit, it increased. The earned income credit, it also increased, as well as $500 credit for dependents that were also on your tax return. So all of these things that I have listed here under Let's Refresh Your Memory are things that existed in 2019, and they still exist for 2020. So the next thing we're going to do is we're going to go over what you need to know for federal taxes for 2020. Now, this presentation I'll have a section on what you need to know for your state of Virginia taxes as well, because there were some changes with the state of Virginia. But right now, we are only talking about changes that occurred with, I'll call him Uncle Sam. The first change, the starting date, if everyone should know by now, it actually started later than it normally starts, because it usually starts at the end of January, but the IRS would not let us submit any tax returns electronically until February the 12th. And they have not changed their deadline. Their deadline still remains at April the 15th, 2021. Now, there are persons who do need to file extensions. Your extensions are still good until October the 15th. But let me let you in on a secret. You have no reason to file an extension if you're not going to send Uncle Sam some money. Because all an extension does is extend the amount of time that you need to get your paperwork in. It does not extend the amount of time you need to pay your bill. So if you owe the IRS, that money still needs to go to them with the extension on April the 15th. Now, there are some people, hopefully most people, who are receiving a refund. You have no reason to ask for an extension, because if you are receiving a refund from the IRS, you actually had 3 years to ask for it. So you have no reason to ask for an extension of time for paperwork, because you had 3 years to ask for your refund. So right now, those who have not filed their 2018 tax return, 2018, you actually only have until this April 15th, 2021 to ask for a refund for 2018. And if you don't ask for it by that deadline, you have just given the government a bonus, because the government, Uncle Sam, gets to keep your money regardless, because he gave you 3 years to ask for it. And if you weren't smart enough to ask for it, then that's on you. You have just made an extra donation. Now, the stimulus checks. Let me speak on the stimulus checks. So the word that they are using in the tax code is called EIP. It's called the Economic Impact Payment. And so back in April of 2020, the government looked at 2018 and 19 tax returns that were on file. And based on the latest one that was available for them to see, they determined, based on your reported income, whether or not you were entitled to receive a stimulus check. Now, most persons were entitled to receive $1,200 per person. So a couple got $2,400. That was in April. Then in January of 2021, they sent out another $600 per person, or $1,200 for a couple. I also understand that if you had a qualifying child that was on your tax return, you got an additional $500 for that child as a stimulus. Now, there are many, many, many persons who either got a reduced amount of that stimulus, those 2 stimulus checks, because their income was higher than the threshold that had been originally established, or they didn't qualify at all. I mean, the income was over even the portion that could be reduced. It was over and above it. So you didn't get a stimulus at all. So let me tell you what IRS has done for those of you who did not get the stimulus check at all. So the IRS has come up with what's called it's called a recovery rebate credit. A recovery rebate credit. So the recovery rebate credit is where the IRS has decided that if your income has changed in 2020, so when you get ready to file your tax return for 2020, if your income has changed where you are below or now eligible for the stimulus that they gave out last year, they are giving you an opportunity to ask for it. So don't be alarmed, and I'm gonna click on this next one. Don't be alarmed if your taxpayer asks you, did you receive the stimulus checks? They're not asking because you're about to pay taxes on it. They're asking because there's a recovery credit that you may be entitled to. So they need to know the answer. Now, I know some people get amnesia and say, oh, I don't remember receiving the check. Or no, I don't know. I didn't get no 1,200. It won't be 600, whatever. Trust me when I tell you, There is a database that the IRS has. They know that you got it. So if you do not tell the truth on that question, both questions, because each question is separate, they're going to ask you about the $1,200 check first. They're going to ask you about the $600 check second. If you do not tell the truth, you are doing nothing but holding up your own tax return, because their database will let them know whether or not you got it. But let me talk a little bit more about this, because I have already prepared some tax returns this year. I saw it with my own 2 eyes. So let me tell you what I saw. I have a couple that in 2019, when their 2019 tax return, when I say it put them way above the ability to collect any stimulus money, I'm not joking, way above. So there was no question. The IRS did not send them any stimulus money because their income was too high. But they had life-changing situation for 2020. They had a life-changing situation in 2020 that caused their income to go down. So in 2020, their income was less than $150,000 for a couple. So when they asked the question on the tax return, did you receive the stimulus check of $2,400 for the two and another $1,200 for the two? The answer was no, they did not receive it because they didn't. But because their income went down, the IRS has given them $3,600 in addition to their refund for 2020. Because in the eyes of the IRS, that means whether it was COVID related or not, anything that affected your income to go down from the year before to the point where you now qualified for a stimulus check, they are now going to give it to you on that tax return. Okay, and it's not taxable, but they're going to give it to you. But let me tell you a distinct difference between what I call the economic payment, the economic impact payment, and what they are now calling the recovery credit. If you remember, and you may have seen it on the news, if you received a stimulus check, the law said that they could not use that money for anything. They could not keep your stimulus check and apply it towards back taxes. They couldn't send it off to somebody you haven't paid. They couldn't send it off to the state because you ain't paid your child support. They couldn't do a thing with the economic stimulus check. But if you are entitled to that recovery credit when you file 2020, keeping in mind, the only way you can get a recovery credit, you must file 2020. They're not going to just send it to you. No, you must file 2020 and ask for it. But if you get that credit, because it does not fall under the same definition as stimulus, they are allowed to hold that money and put it against a bill. So now I had a couple the other day that wasn't a couple, it was a single person the other day that when I did his tax return, he owed the government $2,000 because he didn't have anything taken out the paycheck. So he received unemployment, which I'll talk about later, but he owed $2,000. But because he had not filed his 2019 tax return, matter of fact, he hadn't filed it, he never received the stimulus check. So I was able to tell the system, no, he didn't get it. So give him his recovery credit of $1,800. But because it's a recovery credit, they just reduced his tax bill from $2,000 to $200. He will not get a stimulus check in the mail. He will not get a recovery because recovery is not subjected to the same law as your economic impact payment, which said they could not keep that stimulus check for any reason, but the recovery, they can use it for any reason. So if you owe the IRS, you get the extra recovery, they will apply it towards your tax bill for 2020 as you're preparing your taxes. Do I have it? Do I need to stop? Do I have any questions right now while I'm into the stimulus? I can't hear anybody, so.
Yeah, there's a question in the chat. What is
Yes.
the threshold? I believe that's the question. Yeah, what is the actual threshold for the IEP and recovery rebate credit?
So the threshold is actually the same as the previous stimulus checks, which was 150,000 for a couple, 75,000 for single, and then the rate went up. So it scaled. In other words, so if you were single and you made over 75,000 but didn't make over, say, 85, then they prorated the amount of the stimulus. So you will only be entitled to whatever your 2020 tax return is saying. So if you have, as a single person, less than 75,000, then you will be entitled to the entire $1,200 rebate credit. And then it'll get prorated based on your income. So it'll use the same thresholds it used for the economic payment. It's just that they got a new term for it this year. It's called recovery credit. Did I answer your question, whoever that was? Any other questions in the chat? Okay, so let's move on. If you collected unemployment, it is taxable. And the majority of unemployment compensation checks I have seen, they did not have any federal taxes withheld. So I've got some clients who are crying because they owe the government, because they received unemployment. It was a bad time of the year. They lost their jobs, but Uncle Sam still wants his portion. And so we have a lot of people who did not have their unemployment, did not have federal taxes withheld from their unemployment. So therefore, they'll feel the effect of it when they do their 2020 tax return, unless they got, deductions, which I'll get into in a few. There's a new law. Because of the persons who were not able to itemize, the government is still allowing you to take off a deduction not to exceed $300 for charitable contributions that were made in 2020. So you could be in a situation where you cannot itemize, but if you know that you gave away up to $300, and that's not $300 per person, that's $300 per tax return, then you can deduct it above the line to arrive at taxable income. So it's just a matter of recording no more than $300 on the 1040 if you did not itemize. Now, of course, if you itemize, you can't turn around and record another 300. You put it all on Schedule A, okay, if you itemize. But if you did not itemize, just know that you still can reduce your taxable income by an additional $300 to arrive at your tax rate. I need everyone to take the time and just, you're not going to memorize this chart. You're not. But I wanted everyone to see the 7 federal tax brackets for 2020. And just see that it goes from a rate of 10% down to a rate of 37%. And it depends on whether or not you're single, whether or not you're head of household, or whether or not you're married, filing jointly. And for those, I didn't take the time to do married, filing separately, but usually it's the same thing as single. So married, filing separately usually have that same rate as single. It's just that your tax rate may be a little higher because you get a penalty for filing married, filing separately. There is a penalty, a built-in penalty on income. And not only that, but there's some things you can't deduct when you do that. So anyway, I wanted everyone to see for a moment, and you can probably glance and tell where you fit. But keeping in mind, tax brackets are actually based on the bottom line. It's not, if you make $100,000, don't just assume that your tax bracket, because you make $100,000, 22%. That's not true. The question is, how much can you get that 100,000 down to be taxable? So if you can get your 100,000 down and get it down to 50,000, then your taxable rate is 12. If you look back at that chart. So it all depends on how well you do your homework to reduce your income so that your tax bracket goes down. Any questions on the chart? Okay. Now, this one deals with standard deductions. So I want to bring a point here. If you follow me and look at, let's just look at a single person. So back in 2017, a single person only needed to have $6,350 to itemize. But that same person now needs $12,400. What a difference. It's almost twice as much. And suppose they don't have any dependents. So that means they need even more to get above the itemized. Look at married couples filing jointly. It used to be $12,700. Now it's $24,800. And if you're 65 or blind, it's $1,300 more. So for some people, this is an advantage. But for some people, it's not. It all depends on your situation as to whether or not standard works for you. Matter of fact, in some people, standard was a gift. But I have many people that taking away their ability to itemize worked against them. It put them in a higher tax bracket. So it all depends on your situation. Are there any questions on this standard deduction versus the itemized? My next slide shows you, for those who are eligible for earned income credit, to give you an idea on what the credit, what makes you eligible as far as income. And a lot of people didn't know that you do not have to have children to be eligible for earned income credit. Most people associate earned income credit with folk with children. But your income can be so low. Look at that. Your income can be, you could be a single person with $15,800 as your income, and you're eligible for credit, earned income credit. And that's where the government's giving you some money. They didn't take it from you, they're just giving it to you because your income is so low. So I wanted you to have this so that you will understand that based on people's income for 2020, there are a lot of people now whose income is substantially different than what it was in 2019. So it's a possibility that you may qualify for earned income credit, whereas 2019 you didn't. So this is just to give you an idea of what it is. Any questions while I'm about to leave the area of federal? I'm going to the state in a minute. Not that I won't touch base on something else on the federal, but right now, that's what I have for federal before I get into the changes that were made to the state. Any questions in the chat or any questions, period?
Yeah, there's a question in chat from Eunice. It says, what happens if only one of the couple turns 65 in a year? Does the $1,300 factor in differently?
Yes, so what happens is and you're talking about the standard deduction. So
Yes.
it's $1,300 per person. So if a couple does it and two of you, then you're talking $2,600. So, but if just one of you is 65, then it'll only be the 1,300. So the
Thank you.
itemized deduction, I mean, your standard deduction will go up by $2,600 if both of you are 65 or older. Does that answer your question, Eunice?
Yes, thank you.
Oh, you're welcome. Any other questions before I move off of federal? What you need to know for the state of Virginia for this tax season, 2020. The first thing you need to know is that the state finally got their little act together because, see, if you remember, when they changed the law in 2019, the state didn't quite have enough time to figure out what these standard deductions need to be on their tax return. And then they end up sending everybody an extra bonus check because they knew that they didn't do their tax law correctly. So everyone got a little check as a rebate for your 2019 tax return. This year, for 2020, they have raised the standard deduction from $3,000 to $4,500 for those who are filing single or married filing separate returns. If you're married, that standard deduction has increased from $6,000 to $9,000 for married filing joint returns. Now, keep in mind, and later on, I think I show it again. If you use a standard deduction for federal, you must also use it for state. If you itemize for federal, you must itemize for state. The two must be the same. And for those couples who are married filing separately on the federal, whatever one does, the other must do. You can't have a married couple filing separately. One person takes standard deduction and the other one takes itemized. Nope, it doesn't work that way with the IRS. So y'all need to talk and get an agreement because whatever way one files, the other one must also file. So either you're going to be standard or you're going to itemize. The state of Virginia. This is one item that I thought truly, and this is just my opinion, was not fair. So the state of Virginia only has 4 income tax rates. So you see them there from 2% to 5.75%. But everyone pays the same rate regardless of your marital status. This has nothing to do with marital status. This has all to do with income. So that's like, a couple, you would think if a couple, I'm going to pick on the 5%. Let's say a married couple only brings in $17,000, their rate shouldn't be no 5%. You would think their rate would be lower because it's 2 people. But that's not the case. They still pay the same 5% as someone single with the same $17,000 in taxable income. So I'm not here to tell the state what to do. I just have an opinion that this just doesn't appear fair. But it is what it is. And I'm just a messenger. But 2% to 5.75% is a tax bracket, tax rates. And remember, those tax rates are actually based on not how much you brought in, but what is your taxable income? 2 different numbers. So the lower you get your taxable income down, the lower rate you pay. But you have to get it down. You got to do your homework and get it down. So I already mentioned to you about itemizing on the state, only if you itemize on the federal. But the state of Virginia has given y'all a couple prizes. These are things that caught my attention that I learned something new as well. The first one, you remember back there earlier when I was talking about persons who itemize are limited to $10,000 in the area of state taxes withheld, or state, the section on Schedule A that covers your state taxes withheld, it covers your real estate taxes paid, it covers your personal property taxes paid. And remember I said, suppose you got $15,000 worth of stuff, but the IRS only allows you $10,000 because they stopped you. The state is allowing you to take the additional that you lost and take it off on the state, providing it was real and personal property that was imposed by the state of Virginia. So that means that if your real estate taxes were $8,000, but your itemized deductions for states for the tax section puts you over and above the 10, then you can possibly use a portion of that 8,000 and place it on the state return as an additional deduction because you were not able to take it off on Schedule A. But keep in mind, you must be able to itemize in order to take that deduction. Y'all got me? The next thing I saw that I liked was licensed primary and secondary school teachers who have tuition costs that are out of their pocket for continuing education. They're allowed to take off 20%, but I need you to clue in on that word that says these courses are required as a condition of employment. Okay, so now I'm not trying to be funny, but if you're teaching social studies, but you go take a class on how to cook, I don't think that's going to quite qualify. Okay, but if you're taking social studies and you need to take a course to enlighten you maybe on African American history, then I possibly could see that. If your job requires you to know more about African American history, and so therefore you incur the cost out of pocket. So I'm trying to tell you, don't get too creative in this area because it says you can take it off if it's required as a condition of employment, 20%. The next item. A lot of us do not take this. Matter of fact, I'm not here to preach about insurance, but I tell you what, for all those who can hear me, it is more important, in my opinion, to have long-term care insurance than it is to have life insurance. If you long-term care insurance actually is to take care of you in your later years. But the later you wait to get it, the more it costs. It comes to the point of being unbearable, unable to pay for it. But there are a lot of us who cannot, although we itemize our deductions, there are a lot of people who cannot take the deduction for medical expenses on Schedule A. And that's because medical expenses must be 7.5% of your income or more. So it has to exceed 7.5% of your income. So if you're bringing in $100,000, and they're not talking about taxable income, they're talking about the gross income you bring in, not your taxable income, gross income. So if your gross income is $100,000, to keep this simple, that means you need over $7,500 in order to itemize medical. But it's not impossible to get it. It's just very difficult to get it. Examples. Sure, we pay health insurance premiums, and sure, health insurance premiums are a lot of money. However, for those of you who are working, most likely your health insurance premium is pre-taxed by your employer. So it doesn't count as a deduction because your W-2 was already reduced by the premiums that came out of your paycheck. So you can't turn around and take it off again on Schedule A because your premiums were pre-taxed. But for those of us who are retired and our premiums are not coming out of our retirement checks, we are sending the check to Anthem. They taking it out of our checking account. Then yes, those are out-of-pocket premiums for us. But you also get to deduct any co-payments that you made out of your pocket to your doctors. Just go to the hospital for one day. That's a big co-payment. Go to the emergency room for a day. That's a big co-payment. But keeping track, even the eye doctor, the dentist, keeping track of all your medical, I'm just saying, at the end of the day, the average person cannot deduct or itemize medical because it's very difficult to get over the 7.5%. So what the state of Virginia did, they said, for those of you who have long-term care policies and you're making payments every month for those long-term care policies, we're going to allow you to deduct those premiums to arrive at your taxable income on your state return only. But that's providing you itemize federal. It doesn't mean you got the deduction on federal. It only means that you itemized your federal, but you lost the ability to take it off because you didn't have enough to get you over the 7.5%. So the state is saying, well, then we'll let you take it off over here. Does everyone understand that concept? And any questions? Any questions in the chat on that? Or anyone have a question? Okay. The next thing I saw that caught my eye is if you bought any energy efficient equipment, dishwasher, I can't name everything energy efficient, but energy efficient equipment, okay? You're allowed to take off 20%, not of the equipment, but of the sales tax paid on the equipment. Two different figures. So don't give your account, oh, I spent $1,000 replacing this dishwasher, and that's 20%. No, you ain't, yeah, you pay $1,000 for the dishwasher, but you don't get to deduct 20% of the dishwasher, okay? You get to deduct 20% of the sales tax. So the sales tax in Virginia, I guess about 4.5%, 5%, whatever it is, you get to deduct 20% of that. So that might turn out to be $10, but something is better than nothing. It still reduces your taxable income, but they're making it clear. It's only 20% of the sales tax paid. Okay? What time is it? I'm sorry. Make sure I have enough time. God, already. All right. I wanted to bring this up, the Virginia College Savings Plan, because the state of Virginia, this is also another way to reduce your income, because they have several Virginia 529 accounts where you can put away $4,000 per year for each child, and do it for your grandchildren, because it reduces your taxable income to the state. Now, this is not deductible on the federal. This is strictly for the state of Virginia, having these 4 different accounts that allow you to put it on. And as long as you are the owner, the one that prepared your tax return, you are the owner. Even though you name them as the beneficiary of it, you can deduct this from your income. And this has nothing to do with your income. This is deductible by the state regardless of your income, $4,000 per child.
Hey, Gwen.
Yes.
Dawson's have a question in the chat. It goes back to your prior topic. Does energy efficient equipment include electric vehicles?
I don't believe it did. I do not believe I didn't see vehicles on there. Because yeah, that's stretching it that a vehicle is equipment. But I didn't see the word. I saw things that were in your home. They were talking about improvements to the home that were energy efficient. It actually didn't speak. And that's a good one though, because it could come up in the future. But right now, this was talking about appliances, things that that were energy efficient in your home. And is there any other questions in the chat on that?
No other questions.
Okay. So back to the federal taxes. Because we have children who are in college, and tuition is not cheap. There are 3 different credits that the government does allow for those attending college. But where we fail what we fail to realize sometimes, when we think of college expenses, we're looking at the whole picture. What did it cost me out of my pocket, or even loans, to send this child to college? And the government is saying to you that the only thing deductible will be things that deal with their tuition. Sometimes school fees, you have lab fees, you have equipment you may need to buy, like a computer. You may have, I know they have books to buy, but under no circumstances does it include room and board. Room and board and transportation do not qualify for the credit. So what happens is you receive a 1098-T from their school that says up at the top, this is the tuition that was paid. And the first thing we're thinking is that I know we paid more than this for them to go to that school. I know we did. But what you're not realizing is they cannot report what you pay for room and board. It's not tuition. Tuition is tuition. That is not room and board. Yeah, you paid it, but also it's not deductible. It's not a deductible credit. It's not a deductible expense for obtaining the credit. Then you also will see on that same 1098-T, you'll see a block that talks about scholarships. So this is the money that was granted to them to help pay towards their tuition, not to help pay towards room and board, to help pay towards tuition. And you would hope, I would hope, that if that number is lower than the tuition, then you have a credit coming. But if it's not, then you don't have the credit. Because if their scholarship is more than tuition, you did not have eligibility for these 3 credits that the government is offering. Now, each credit has different rules. So only the American Opportunity Credit is strictly for undergrads. It's for their first 4 years of college. So if you're in grad school, the American Opportunity Credit is not for you. You can't use it. This is only, and that's why I was giving you the points up here, this is only for those who are undergrad that can take these expenses. And then the credit, the most you're going to get is $2,500. But $2,500, trust me, a $2,500 credit, it is not a deduction. A credit is worth more to you than a deduction. A credit is dollar for dollar for your tax bill. So if your tax bill says 10 and you're getting a credit of 25, then your tax bill is 75. That is worth more than being able to deduct from your income $2,500, because that $2,500 might only be saving you $500. But to be able to deduct the whole $2,500 from the $10,000 is worth it. it's much better. But they have income limits. All of them have income limits. I did a young lady the other day that had tuition, and no, she didn't have scholarships, but she was single and she made $90,000. I had to tell her, the government says you can afford your own college. They're not gonna give you no credit. You single with 90,000? No, you pay for college because they're not gonna give you the credit. And the same thing gonna happen to a lot of you. You look at this and you will see married couples, you make over 180, you can forget it too. You make over 180 as a married couple, you can forget about this credit as well. Because you make too much in the eyes of the, now I'm not saying you make too much, I'm just a messenger. I ain't saying you made too much. I'm saying the IRS said you made too much. And so you're not going to get the credit. So that's for the American Opportunity. But let's go to the next one. There's a lifetime learning credit. So the lifetime learning credit, you get 20% of the first 10,000. That's $2,000 credit. But notice that it's for undergrad, grad, and non-degree or vocational students. It covers more. The American Opportunities, you got to be going after a degree. This one is for undergrad, grad, non-degree, or vocational students. But look how they changed and lowered the amount of your income to qualify. So the single person you see has to make less than 59,000. The last one I told you was higher than that. So now they done lowered it in order to get this one. The same thing with married couples. It was 180,000 on American Opportunity. If you look at this, you get a reduced rate after 138,000. So they've lowered it. But the same rule still applies. That personal expenses don't qualify for this credit. Now, I want you to see bullet number 3 on there, and this applies to all of them. Some because we tend to get creative, but you can't claim both. You can't. You need to pick which one gives you the best result, okay? Because you can't be picking all of them because it's not gonna happen. When you're gonna file that tax return, you're gonna get one of them, but hopefully the one that gives you the best result. But most tax softwares compute the one that gives you the best result based on your information that you put in. And after the lifetime learning credit, there's a tuition and fees deduction. So this tuition and fees deduction allows you to deduct $4,000 of eligible education expenses to get the credit. So this one has income limits as well. So all of them, I brought this up because I thought, in this day and time where we have children, we have grandchildren who are in college, but some of us grandparents, although we're helping out, if the grandchild is not on your tax return, trust me, you will not be claiming this credit, okay? The credits follow the student wherever that student is listed on a tax return. So if the student is on the parent's tax return, then the parents are the ones that get to use the tuition credits, the 1098Ts. They're the ones that get these credits that I'm speaking on. But that student is filing their own tax return as an independent, then only they can make the claim. You can't make the claim if they're not on your tax return. So these tuitions, these education credits follow the student, depending on whose tax return they're on. Now, mind you, there are students who are still filing their own tax return, but they have indicated to the government that they are being claimed by their parents. So if they're indicating to the government, I am being claimed by my parent, then that tells them that the parent is the one really claiming them, and the parent is the one entitled to these tuition credits. But the student is only doing that so that they can get back the money that was taken from them while they work their little part-time jobs. It doesn't stop them. I mean, they have to make a lot of money to not be able to get back their money and still be claimed by their parents, because it's better in some cases. Now, I have seen situations, and I'll speak on one, where I have a college student who was claimed by their parent. The parents' tax return only gave them an extra $500 refund in 2019. So they got an extra $500 refund in 2019 for the stimulus. I mean, it was a child credit, but then they also got $500 stimulus because they were claimed on that tax return. But had that child filed their own tax return, that student not only would have gotten the $1,200 stimulus check, the first one that came out, they would have got the $600 one that came out. And guess what? They would be entitled to this $1,400 one that's about to come out, had they been independent. So while parents are busy getting the extra $500, you stopped the stimulus checks that would have came to them and would have been way more than the benefit you received having them on your tax return. So I saw that also with my own two eyes. But I'm not here to tell you which way to handle it, whether or not you claim them or don't claim them. I was just giving you an eye opener to things that happen whereby some college students who work part-time jobs could not get the stimulus check because they were claimed by their parents, and therefore they don't qualify for the stimulus. I'll give you another example. I actually saw with my own two eyes where last year, 2019, a person was single and was eligible for the $1,200 and the $600. But let me back up. They were not eligible for the $1,200 or the $600. They were single. They made over $75,000. But in 2020, they had a baby. So the government says to you, because you had that other dependent on your tax return, the government says to you, did you get the $1,200? The answer was no. Did you get the $600? The answer was no. But they also go ask you, did you get the $500 for your child? Well, the child won't heal. Just think about it. I just said the child was born in 2020. The child was not here in 2019. But because that child's here in 2020, they're going to get the $500 for the child because their situation changed for 2020. It wasn't the situation for 2019, but it changed for 2020. So anyway, I know my time is about to run out on y'all. I have questions. Any questions?
Yeah,
I know I've gone over quite a few things. I did the best I could in such a short time, because you can talk forever about taxes because there's so much. But
Gwen,
I want to open this up and say, let's throw out, is there anything that I need to clarify better for you, or you have a question about something that maybe I can help answer?
Yeah, Gwen, I'm just going to go there. There's a comment and also a question in the chat. The comment is from Dr. Campbell. She says, thanks, Gwen. I have to remind my granddaughter, Bree, she can't claim all the credits, laugh out loud. And then actually 2 questions. I'll just do one at a time. This is from the Dawsons. Are these credits per child student or for all, i.e. all 2 or more students, i.e. 4 per return?
No, it's per student. It is per student, per dependent on your tax return. You get the same amount allowed per child on that tax return. It's not based on just the tax return.
Also, Tiffany Jefferson, she said, hey, everyone, are online tax software programs reliable, or should you seek professional assistance? My tax status has changed. When is it best to seek a professional?
Okay, so in my opinion, there are some people, although I could sit here and tell you that a lot of the online software, in my opinion, is simple. It's not difficult to use. It's a matter of answering the questions that they're asking you, answering them correctly, and it's guiding you through the next step. But some people, even as simple as it may be, are intimidated. They're scared. They don't even want to take the chance of messing it up because they're thinking in the back of their mind, oh, maybe I'm missing a deduction I should be entitled to. But if you go through that software, the way it's asking the questions, it should pick up every deduction you were entitled to if you're answering the questions correctly. So at any time you feel that it's better to give it to a professional, because of, you have to keep in mind, professionals also have the ability to research a subject. So while we may be working on your particular situation, if something were to come up, we could tap onto a research library and get the answer and gain more understanding on a subject matter to help you and in possibility help lower your taxes. So it all depends on how simple your situation is. Some people have very simple situations, some people don't. I tell you what, there are a lot of people who are only receiving a W-2. They don't have a house. They're not paying any mortgage. They're not paying real estate taxes. They don't even contribute to the church. All they got is a W-2. Well, if that's all you have, then you most likely will get the standard deduction anyway. There's nothing to research. Use a simple one that's online and not pay the fee. That's my opinion.
Right.
Next question.
Well, there's a next comment is, just lost it. Tamika said a lot of great information. Thanks so much. The Wallaces, their question is, are there other ways to reduce taxable income?
Okay, so this is my opinion. Yeah, that's a very good question, Eunice. Thank you. I actually spoke on this as a part of my seminar last year, where we failed to realize that sometimes we do have the ability to lower our taxable income, and it's sitting right inside your house. There are persons, honest to goodness, sure as my name is Gwen, that are probably sitting almost with the ability to itemize. You might be maybe 1,000 or 2,000 short of being able to itemize. And I say, go clean out your closet. Go clean out your garage. Clean up the attic and go donate that stuff to the Salvation Army, Goodwill, of the thrift store. Go donate it, because there is a website called Intruit.com. It's under Intruit. Intruit, I-N-T-U-I-T, Intruit.com. It's the same as TurboTax. They make TurboTax. And Intruit.com has a software called It's Deductible, ITS Deductible. The reason why everyone needs to set up their own free account on It's Deductible is because it guides you through the inventory. See, it's not good to say, oh, tell the IRS, oh, I took a bag of clothes and donated it to Goodwill. And they say, well, what was the value of it? Oh, $500. How you know? How you know that that bag of clothes was worth $500? Did you take an inventory? You know what? Prove it. Take an inventory. Key the inventory into It's Deductible website, and it calculates it for you. You tell them I gave away 20 blouses. It takes 20 times 10, 200. You know, I gave away 5 pair of jeans, 5 times 15. You understand? So it keeps track of it for you. And at the end of the day, that is more convincing to the IRS that you did your homework. And the other thing that's good homework, take a picture. Y'all take pictures of everything else. Take a picture of the pile of stuff you get ready to take over there to Goodwill. What's wrong with a picture? A picture is worth 1,000 words. Take a picture. But the point of the matter, you have to have a methodology for coming up with donations. Trust me when I tell you, the reason why, and I know, the reason why they stopped us, I'm saying the government stopped us from being able to take away cash contributions, because we were making up the number. Yeah, I go to church every week and I put in $20 in the plate. I know I put in $20 in the plate. I need you to deduct that. The government said, oh no, you are now going to prove that you put that $20 in the plate, because you can't, cash contributions have to be acknowledged by the recipient. So Third Street would have to, as an example, Third Street would have to acknowledge, I did receive X amount of dollars from Gwen Carney for this tax year 2020 in the amount of whatever. And it could, some of it could have been in the way of cash, but you can no longer say, I gave cash without proof. Same thing with those clothes. How are you going to say it's worth 500? It looks like a made up number. Why can't it say 473? That looks like it's been calculated. 500 is made up. Okay, that answer your question, Unit?
Yes, thank you.
You're welcome.
The next question, Tiffany Jefferson in the chat room asks, are you accepting new clients and how can we get in touch with you?
And y'all gonna record this? Cause I don't want everybody in the United States calling me. But anyway, y'all give Tiffany my number, okay? I'll leave it like that.
We'll make sure that the information goes out to Tiffany.
Okay, sure.
The next question in the chat room is from the Dawsons. Great information as always, Sister Gwen. Thank you, and thanks to our personal finance ministry leaders. Then the next question is from Brother Barton. He says, if I use a healthcare savings account, can I deduct the long-term healthcare premiums? Okay,
so the healthcare savings account usually is the account that's been established at work. And at work, that's usually to cover your co-payments. So it will be new to me because I don't know everything I need to know about health care savings accounts, because I thought that you get reimbursed by the company as you show proof that you have paid out of pocket. I have never seen that kind of plan reimburse you for premiums paid. So long-term care to me sounds like, I know it's something that's a premium based medical expense that I don't really know that you could take and prove to the HSA that I spent money on long-term care policy and I need you to reimburse me. I think it was set up to cover your co-payments, even co-payments like to the dentist, purchase of eyeglasses out your pocket, but I've never seen it reimburse you because you had premiums that you paid, even in the way of health insurance or long-term care. Did that answer your question, Barton?
I don't know if this is Michael.
Yes, thank you. This is Joe Barton. Yeah, thank you very much.
Oh, you're welcome. Yes, Mike.
I have a question. You may have answered Joe, but I have a question. If you have a healthcare savings account and you contributing to premiums in a separate entity, can you deduct the premiums even if you have an FSA at work?
Okay, so are you talking about premiums that you're paying?
The long-term care premium is with a separate insurance company, not associated with FSA. Can you
right? So I'm telling you that the long-term care premiums are deductible on Schedule A under medical expenses itemized. And so I was said earlier that there are a lot of people, although we have those premiums and although they are deductible, if your total medical doesn't exceed the 7.5% of your income, it becomes non-deductible. So what you can do though is still deduct it on your state tax return because the state is allowing it, providing you itemize your deductions for federal. You understand?
Yes, thank you.
Okay, you're welcome.
Gwen, this is Joanne Bush. I have a couple of questions.
Okay.
For a high school student who worked some, does the person have to file the W-2 with their parents, or is it sent in separately?
No, a student that works themselves, their W-2 is their W-2. They file their own taxes, but let me let you in on a secret. You need to look at that W-2. If there were no federal or state taxes withheld, there's no reason to file it. And it also depends on the income. So most likely you're talking to someone who was working part-time. They didn't make a whole lot of money. Most likely, if they're not fitting in the category of having income that's taxable, if the government did not withhold any federal or state, there's no reason that you're not gonna get it. They're not gonna get a refund because they're being claimed by a parent. But they do, that W-2 does not go on the parent's tax return. No.
Okay. For 529 plan, if you didn't pay $4,000, but you contributed $3,000, is there a percentage for the state that you can deduct?
You could deduct up to 4,000. So you didn't have to put in 4. They just gave you your limit on how much you can contribute to the 529. So you still can deduct the 3,000. It just limits you and stops you after you have contributed 4.
Okay. So my last question has to do with the stimulus. Some people were saying if you think you were entitled, did you get any kind of notice? I never saw anything in my checking account. Did they send you a notice that you were supposed to get something, or how do you track it to see if you were entitled to get a stimulus? Was it a letter sent out? Did it show up in your checking account, or how?
Okay. So as far as I know, because matter of fact, the last write-up that I read about the stimulus, they say that they have distributed all the stimulus they're going to distribute. So now there's no such thing as an economic impact payment now. Now it's called rebate recovery credit. But I have only seen one letter, even though they say 2 letters went out. They say that when they gave out the stimulus for April, they sent letters out a couple months later telling you what your stimulus was. When they sent the letter out, when they gave you the stimulus in January, they sent out a letter also about the $600 stimulus check. And I actually know that one did come out. So what's happening is, regardless of whether you got it or not, the 2020 tax return is your opportunity. And I was teasing when I said, now don't y'all put down, oh, I didn't get the money. But if you honestly don't believe you got the money, this is your opportunity to ask for it. But the only way I can tell you, Joanne, the best way to confirm it is whatever banking institution you use on your 2019 tax return to receive your refund or to make your payment. That is the institution that you need to be able to either go online or obtain your previous year's statements and look for a deposit from the IRS. It'll say U.S. Treasury. Look for a deposit, and it would have happened in April of 2020, and then again in January of 2021. Those were the 2 payment dates, the payment periods. If you don't see them, then when you file your 2020, ask for the money. It'll let you know if you qualify for it anyway.
Okay, thank you.
You're welcome.
Hey, Gwen. Well, Reverend Boyd has a question in the chat. Let me just, it says, great information, Sister Carney. Is there a maximum donation you can deduct for donation?
And yes, there is. And I can tell you that the average person doesn't do it. the maximum you can donate is 60% of your income. And who in God's name does that? Okay, so 60%. We can't get folks to give 10%, let alone 60%. So you're allowed to deduct up to 60% of your income. People ain't even giving away 10%. So yeah, sky's the limit as far as I'm concerned, because no one, I can't think of anyone who gives away 60% of their income. That answer your question, Pastor?
It did, thank you.
You're welcome.
Gwen, I have a question about in-kind services. Is there, how do you verify in-kind services for IRS? Or how do you value in-kind services?
So in-kind services, which is a whole nother subject, because that doesn't even go on a tax return, because they'll tell you cannot come up with the value of volunteer service. That's impossible to even come up with the value of volunteer service. So you're not going to be able to take it off. But I did see one area, under deductions, you are allowed to take off what's called charitable miles. So if you're running back and forth to the church daily, okay, whether it's for the feeding program or anything else, if you keep track of your miles that you put on your vehicle for the year to keep going back and forth to the church for charitable reasons, because church is considered charity, that's nonprofit, then you can deduct the mileage times 14 cents per mile. As a deduction on your, but that's only if you itemize. So I don't know that in-kind is really something that goes on your tax return, only those charitable miles that I know of.
So Gwen, you mean when we go to choir rehearsal, all that driving back and forth to choir rehearsal, we can deduct that?
I'm saying be creative. That's going back and forth to the church, but all I can tell you, if you keep track of a log, a lot of people don't use log systems, but they really do serve a purpose. When you are able to show the reason why you went to the church, instead of guessing out the top of your head, oh, I know I done put 3,000 miles on my car for things I did at the church. It's like, how did you even arrive at that? How did you arrive at it? So if you have a methodology where you're keeping track, or a calendar that says, today I went to 3rd Street to do whatever, I'm sorry to keep picking on 3rd Street, I know most of us are from there, then you have documentation to show that you did something for charitable purposes. But like, you can't take off because you went to church service. You went to worship. That's not to perform a charitable duty. You understand? There's such a thing as helping out a nonprofit with something. In other words, you're providing a service. You're providing a service. I don't know that preparing for a worship service is considered providing a service. If you understand, I would agree that the feeding program is providing a service. I can't sit here and say singing on the choir it helps the worship, but it's I don't know the best word to use. I'm just, do y'all follow me without me coming up with some more words? Okay.
I have a question. Actually, I have two.
Okay, Bert.
All right, one is, if you got the April stimulus and the January stimulus, they're both deductible, or they're both credited for the 2020 taxes.
Okay, so
April.
That's a question?
So are they both deductible or credited for 2020, even though one was received in April and one was received in January?
Okay, so those stimulus checks, regardless of when they were received, were for informational purposes only, because neither one of them are reportable. They're not income. It was just for information purposes only. They wanted to know, did you get them?
Okay. And the second question is, you talked about paying long-term insurance premiums.
Yeah.
What if you have additional premiums? Like I have an Aflac policy, which is medical as well. Does that fall under the 7.5%, or is that deductible any other way?
Okay, so that does fall under the 7.5%, just like the long-term care policy premiums fall under the same.
All right,
So
I'm
it's a
grateful,
matter of
Mike.
adding all that together.
Okay,
say?
thank you very much.
Oh, you're welcome. Any other questions?
Yeah, there's a couple more. Tamika said, really enjoyed this today. Got to leave the meeting now to get on the road. Everyone have a great weekend. Brother Moss and Angela, Tony and Angela, the question is, there were some changes pertaining to the 2020 Social Security tax withholdings. Could you elaborate?
The 2020 Social Security withholdings? I don't have those rates in my brain, but I do know that, and what you're probably speaking on is that there's no limit, I believe, on Social Security rate, which is 6.2%, but there may be a limit on the amount of income for the Medicare, which is 1.45%. So I think when persons make a certain amount, and I'm a guess at it, let's say you have a W-2 that makes over $200,000, then at some point it doesn't charge you any, it doesn't take any more Medicare tax from you, because there's a limit on how much the max that they can take from you in the way of Medicare tax. I don't know of any other tax changes for Social Security. Any other questions?
All right, Gwen, that's all the questions in the chat. Does anybody else have any questions? All right, the next personal finance ministry meeting will be on March 20th at 11 a.m. More information will follow or will come. And as we indicated earlier, we are going to pick back up with Reverend Sori's book, chapter 5. So be mindful of that. You'll get information. Gwen,
Yes,
thank you so much.
you're welcome.
For we know it's you gave up your time and your professionalism, and you always explain it in a very poignant way, in a very easy to understand way. And
Yes.
you know, this, as you said before, this is a topic that is very challenging. People get intimidated by, and you break it down so well. And on behalf of the personal finance ministry, thank you. And you know, if we were doing live meetings again, we would hand you a gift, but we're going to send something to you as we as an expression of our appreciation. So thank you so much.
You're so welcome. I thank all of you for your undivided attention and your interest in the subject. And I wish you much luck and blessings as you try to go through your 2020 tax return. And for those of you that I prepare your return, you know who to call, you know how, you know my number, okay? All right.
We're not going to say it live. And also James over in the corner, but James is a technology guy for Gwen. So James, thank you.
Thank you, James.
You're welcome. You're welcome.
And Pastor, do you want to say anything at this time? You're on mute, Pastor. You're on mute. You're on mute, Pastor.
I guess I better come off of mute. You would think a preacher know when to come off of mute. No, I am grateful to for this ministry, and so thank you, Judge and Dr. Johnson, and all of those that's a part of this ministry, and truly to Sister Carney for always giving us great information. You know, that can help us as we move forward with this. It seems like things just change every year, and so I'm grateful that Sister Carney is willing to sacrifice of her time to do this. So thank you, Sister Gwen.
You're welcome.
To the ministry, and all everyone that attended today. Thank you for coming on. God bless you.
Amen. God bless.
Well, Pastor, since you're still unmuted, do you mind sending us off?
Okay. Oh, gracious God, our Heavenly Father, we pause again in the name of Jesus, truly thanking you for being the loving God that you are. You are the one, God, that has blessed us with all that we have. And so, God, we are grateful and thankful to you, and just ask, oh Heavenly Father, that you continue to keep your loving arms around us all. And as we go forth to make financial decisions, that we will make the correct decisions and the ones that will be beneficial to us. And then, God, that we'll realize, after realizing what you have blessed us with, that we will in turn give back into your kingdom. For you deserve our best, God. So have mercy upon us this day. In Jesus' name we pray. Amen.
Amen.
Amen. And we're gonna send out word as to how you can view the recording. We'll get that out there with all the slides and everything else.
Yes. Thank you.
Thank you.
Thank you, guys.
Good night.
Thanks,
All right, y'all
everybody.
take care.
Bye.
Have a good
Bye-bye.
day.
Two.
Bye-bye.